Hey everyone, welcome to this explainer. I am absolutely thrilled you're here because today we're embarking on a genuinely fascinating journey. We are going to map out the exact progression of an investor, tracing the path from a beginner's completely naive $20 deposit on a random Tuesday afternoon all the way up to $1 million institutional reality. And listen, this isn't just about adding commas to a bank account. It's really about the profound psychological and structural shifts that literally rewire your brain along the way.
There's a quote that brilliantly frames our entire journey today. Most people never lose money in the stock market. They lose it in the gap between what they thought investing was and what it actually is. That gap, it's very real. It is a dangerous, tricky space, and it's measured in both dollars and years.
Okay, let's dive into this. What does closing that expectation gap actually cost? Like, what is the true psychological and financial toll of transforming from someone who just downloaded a shiny trading app to someone managing serious capital? Well, let's break down the levels and find out.
All right, starting off with Phase 1, the initiation. This covers levels 1 through 3, going from 0 to roughly $5,000.
At this stage, you're literally just downloading the app. The market algorithm doesn't even know you exist yet. It usually begins with a small round number, something like 20 bucks. It kind of feels like house money, right? You take that $20 and you buy a tiny 0.18 fraction of a share of some company you recognize. The wild thing is, the platform gives you the exact same charts and news feeds that $1 million investor sees. It's super exciting, but honestly, it's also wildly disorienting because, well, you don't actually know how to use any of it yet.
So, as you cross the $100 mark, you're going to experience your first real loss, and right along with it, a really dangerous cognitive trap. Maybe it's just $47 or $93. You bought a stock purely on momentum because it went up for a few days, and then, boom, it drops 9% in a single session. Now, notice step 3, you refuse to sell. Why? Well, because selling makes the loss real. Not selling keeps it entirely theoretical. This is a completely normal human response, but it's exactly the cognitive pattern that turns a small $93 mistake into a $340 hole.
And that brings us to a concept we call the learning tax. By the time you reach a few $1,000s, your unearned conviction starts costing you real, actual money. You might test out a strategy, like, say, buying stocks that drop 20% hoping for a quick bounce. Let's say it works twice. Honestly, that is the worst thing that could possibly happen, because it builds false confidence. When it inevitably fails on your third, much larger position, you pay the learning tax. You're paying to discover the very hard difference between your beliefs and market reality.
At this level, a 15% drawdown on a $3,000 account creates a $450 hole. That's real money that takes real time to earn back. Building feels like forward motion, absolutely. But rebuilding feels like standing still with extra steps. You aren't really building wealth just yet. You are basically building a dataset of your own behavior under pressure.
Moving right along to Phase 2, the shift. This covers levels 4 and 5, taking us from $5,000 up to $100,000.
In this phase, you finally have real capital on the line, and those intuitive guesses from earlier, they get replaced by deliberate decisions. The math of small differences suddenly becomes highly visible. I mean, the difference between an index fund with a 0.03% fee and an active fund with a 0.75% fee seems like a total rounding error at first glance, right? But when you apply that to a $20,000 position over 20 years at an 8% return, that seemingly tiny management fee strips away nearly $18,000 of your compounding. That's almost the entire original principle, just gone. The cost of not knowing the math here is incredibly steep.
Somewhere in this phase, though, you experience pure magic, the compounding click. It is a real game changer. This is the precise psychological moment when your account starts generating more money from the market's movement than it does from your own physical deposits. It becomes undeniable. The account is literally growing without you doing anything. But with this magic comes a pretty stark reality check. At this level, your behavior trumps absolutely everything else.
To prove that, let's think about two investors with the exact same balance, who hit a brutal 18% market drop. The investor on the left holds firm. The one on the right moves everything to cash to quote-unquote stop the bleeding. Here's the thing. Market recoveries do not send out written invitations, they are only visible in retrospect. By missing that unannounced bounce, the investor who went to cash leaves themselves permanently underwater compared to the one who just sat on their hands and held.
So the crucial point here is that you're now learning the actual geometry of the game. Let's talk tax efficiency. Holding an asset for 364 days triggers ordinary income tax. But holding it for just 2 more days, pushing it to 366 days, shifts you into long-term capital gains at 15%. On a $15,000 gain, simply waiting 48 hours can save you up to $3,000. I mean, wow, the system's incentives are starting to work for you, but only if you know how to use them.
Now we hit phase 3, the heavyweight. Levels 6 and 7, from $100,000 to $500,000.
Crossing this threshold fundamentally shifts your structural power within the market. Hitting this mark officially puts you in the top 10% of American investors by account size. You're no longer silent when the topic of money comes up in a room. You have context, you have the vocabulary, your knowledge is compounding right alongside your capital, and actually, your broker starts treating you differently too. You get better data feeds, deeper analytical tools, and access to premium service tiers with real seasoned professionals.
But here's the catch. Serious money attracts serious decisions, and serious decisions attract the possibility of serious mistakes. You aren't paying a cute $93 tuition fee anymore. At this heavyweight level, an expensive error is a $30,000 concentration bet on a single stock, a mistake that's often dressed up as really deep, sophisticated analysis. But guess what? The market still doesn't care how sophisticated your reasoning is. It literally only cares if you're right.
As you approach that $500,000 mark, you cross an invisible threshold. No one sends you a welcome email or anything, but suddenly, better advisors actively want your relationship. Fee structures, yeah, those become negotiable now. And because you're now classified as an accredited investor, you unlock access to the whole shebang: private equity, hedge funds, and real estate syndications. Just remember, though, this access isn't an automatic upgrade over your standard index funds. It simply introduces new, complex risks that are uniquely real to this level.
Psychologically, your entire experience starts to become a lot quieter. You shift away from accumulation mode, where you're constantly anxious about your financial survival, and you enter preservation mode. You actually start thinking in terms of decades rather than months. The primary question isn't really whether your account will grow anymore, but rather what you're building it toward, and whether your overarching strategy will hold together over a really long time horizon.
And that brings us to phase 4, the final form. Level 8, $500,000 up to $1 million.
$1 million. We really have to pause on this number because this is where the cultural mythology of the word millionaire violently collides with the practical reality of financial infrastructure. Culturally, it's a massive, monumental marker. But mathematically, you only have about 72 hours to sit with that mythology before reality sets right back in. At this level, your identity as a retail investor drops completely. You've undergone a categorical change.
You have officially entered a new institutional reality. Your standard consumer brokerage account is replaced by institutional-grade custody solutions. Your conversations shift from simple portfolio growth to things like estate structures, trust vehicles, and generational transfer strategies. Even the way you trade changes. Your order sizes are now large enough that execution actually matters. A poorly timed market order could literally cost you thousands in slippage. So you're given direct market access and sophisticated infrastructure to handle it.
But here is the ultimate unvarnished truth of Level 8. The system will not protect you from being wrong. It simply gives you better equipment for being right. The market is exactly as indifferent to you today as it was on day one when you deposited those first $20. $1 million locked into the wrong asset is still a massive loss. The judgment, that is still entirely yours.
Which brings us to the core takeaway of this entire explainer. The journey from $20 to $1 million is not a story about money. It is a story about the development of a relationship with uncertainty. Think about it. At level 1, you were terrified of the unknown. At level 8, hitting $1 million really just means you've survived the uncertainty long enough to finally recognize its patterns. So, I want to leave you with this question to reflect on, regardless of what level you are currently playing at. Are you trying to control the market, or are you actually learning its patterns? Thank you so much for joining me on this incredible journey today. Keep learning, keep observing those patterns, and I will see you in the next explainer.